Okay, so let's unpack this. Today we're diving deep into business funding.
Mm,
That's the capital, the money companies really need to launch, keep things running, or even like step on the gas and grow.
absolutely. And getting the right kind of financing, it's more than just important. It's pretty foundational, would you say?
Totally. But it can feel overwhelming. Like, where do you even begin to look?
Well, that's exactly what we're aiming for in this deep dive.
Yeah.
We're using this source, Business Funding Essentials, your capital guide, to kind of cut through all that noise.
Okay.
We'll unpack some key funding types from the guide, get into their main benefits, and really figure out why knowing this stuff matters for your business.
Perfect. So the guide mentions several main types. Each one sort of fits a different situation. Let's start with term loans. That sounds like the standard business loan, right?
It really is, yeah. The guide paints it as getting a single lump sum of cash right up front.
Okay. One big injection.
Exactly. And you agree to pay it back over a fixed timeline, usually with, regular monthly payments that include interest.
Right.
It highlights these as being really good for those larger planned expenses. Maybe buying another company, a big renovation, or like a significant one-time tech investment.
Got it. So a big chunk of cash for a specific big need.
Yeah.
But what if what you need is more flexible, maybe more for day-to-day operations?
Well, that leads us right into a business line of credit. And the guide really stresses the flexibility here.
Okay.
So unlike that lump sum term loan, this gives you access to a pool of funds. You can draw from it when you need it, up to a set limit.
Right. So not all at once.
Not all at once.
Yeah.
And you only pay interest on the money you've actually drawn down,
Okay.
which makes it pretty ideal for managing those cash flow swings,
Yeah.
covering unexpected costs that pop up, or just bridging short-term gaps between income and expenses.
Like a safety net.
Sort of, yeah.
Yeah.
Or like a flexible spending account just for your business operations.
Okay, that makes sense. So term loans for the big projects, lines of credit for that day-to-day flexibility. What about businesses, maybe where customers pay later, like net 30 or net 60 terms? That must create cash flow issues.
Oh, definitely. And that brings us neatly to invoice financing. The guide explains this is specifically designed to tackle that lag in cash flow.
How does that work exactly?
Well, you basically use your unpaid customer invoices as leverage. You can either sell those receivables or borrow against them to get a percentage of the invoice value almost immediately.
So you get paid faster.
Exactly.
Yeah.
It turns that future money into cash you can use right now for payroll, buying inventory, paying your own bills, without having to wait weeks or months for your customers to pay up.
That seems super useful, especially for like service companies or maybe B2B sales.
Definitely.
Yeah.
Now, what if a business needs a particular thing, like a tangible asset, a new machine, or a delivery truck?
Is there funding just for that?
Yep. Equipment loans. They're designed precisely for financing those kinds of physical assets. And the guide points out that the equipment itself usually serves as the collateral for the loan.
Oh, so that might make it easier to qualify for.
Often, yes,
Yeah.
compared to a general purpose loan. And the structure means you can start using that asset, hopefully generating revenue with it, right away while you're paying it off over its useful life.
Right, paying for it as it earns for you. Makes sense. Okay, one more scenario. What about businesses with really steady, maybe even daily sales, like restaurants or retail shops?
Good question. For those situations, the guide brings up merchant cash advances, or MCAs.
MCAs, heard of those. They seem fast.
They often are, yeah.
Yeah.
It's generally pitched as a quick way to get cash based on your expected future sales, especially credit card sales.
But the structure is different, isn't it? Not like a typical loan payment.
Right. It's quite different. You usually get a lump sum, but you pay it back with a fixed percentage of your daily or weekly sales. So when sales are higher, you pay back more that day. When they're lower, you pay less. It's fast, but it's really important to understand the cost. It's often shown as a factor rate, not an APR, and that can sometimes mean it's a more expensive option than traditional loans.
Okay, important caveat there. So clearly, lots of different tools for different jobs, as the guide lays out. Let's talk benefits now. Why even bother with funding? Why go through the application process?
Well, the benefits are pretty significant, according to the source, first off, and maybe the most crucial is maintaining healthy cash flow.
Keeping the lights on.
Basically, yeah. It stops you from getting jammed up when your bills are due, but your customer payments haven't landed yet.
Right, that's survival. But funding is also about more than just surviving, isn't it? It's about moving forward.
Absolutely. Having access to capital lets you make strategic investments in actual growth.
Like what?
Well, maybe grabbing equipment when it's on sale, or hiring that key salesperson who could unlock a whole new market, or just stocking up on inventory before your busy season hits. Things that actively grow the business.
And being ready to pounce when those chances appear. That feels critical.
It is. The guide underscores that. Having funding available or knowing you can get it quickly means you can react fast to sudden market shifts or those unexpected opportunities that need capital right now.
You don't miss out.
Exactly. Plus, there's a longer-term benefit, managing debt responsibly, like paying back loans on time.
And that actually builds something valuable for the business itself.
It builds your business credit history. Think of it like a financial report card for your company.
Okay.
And a strong credit history, built by handling loans well, just opens doors later on. Better funding options, better terms, maybe larger amounts when you need them down the road.
So quite a few advantages there. Okay, so we've unpacked several key funding types: term loans, lines of credit, invoice financing, equipment loans, MCAs, and looked at the core benefits like cash flow, growth, opportunity, and credit building, all based on this Business Funding Essentials Guide. Understanding these differences isn't just, theory. It's really practical.
It's absolutely about matching the right funding tool to the specific challenge or opportunity your business is facing, like right now.
Right. Which kind of leads us to our final thought for you, the listener. Thinking about your specific business goals, your unique challenges, the opportunities you see, how does that help clarify which of these funding options we talked about might be the very best fit for you?
Because exploring options that are really tailored to your situation, your goals,
Yeah.
that's definitely doable.
And the source material we used actually points towards a way to do that.
It does. It mentions calling Joe Starcher Funding at 872-228-5250. They apparently offer fast, simple, and tailored solutions.
Worth considering if you're looking to align funding with your specific business aims.